What's up, guys? Today we're going to talk about the truth about financing your car with an Infinite Bank, and here's everything you need to know before getting started using an Infinite Bank to purchase a car. So the first thing we need to look at is we need to understand how the Infinite Bank works and why we would even use an infinite banking policy in order to purchase a car or anything else like that. So when we look at an infinite bank, so we have our bank here, and so with our bank, we're going to continue to put money in it, okay? So when we do that, what's going to end up happening is we're going to accrue money. It's going to be tax-free, and we're going to have compound interest. Now, this is very important because say we have $20,000. So if we've accrued $20,000 in our infinite bank, what we can then do, let's say we need to use $10,000 to buy a car, if we just want round numbers. So what we would do is we would then take a loan for $10,000. So how we're going to set this up is if you're taking a loan for $10,000, you're going to get that interest rate. It's about 5%. So you have a 5% interest rate. Now, this is where it's going to get a little different than your traditional bank. So what's happened is when you go to the bank and they give you the $10,000 in simple interest on that loan, you're going to pay down that balance. But the money, the interest that they're capturing, we want to capture it all. So when we take the loan out at $20,000 for $10,000, after that, what will happen is we take that loan, but this is still there. So your $20,000 is growing and compounding in the policy. And all you're taking a loan out for is simple interest on that. So as your money grows in one of these policies, what you're able to do is you can take that and you're going to recapture all of that interest. So let's give a real world example. So if we're looking at this and we have, let's say we have $100,000 and we want to spend, our car is $50,000. So how we would structure this is, so we have our $100,000 that is compounding and we want to take a $50,000 loan. So what we would then do is we would calculate out what our payment would be if we were to go to the dealer. So the easiest way to do that would be to go to a car dealership and get all the way there and see what that payment is going to look like. Okay, so let's use a round number. Let's say we're paying $1,000 a month. Okay, so what you're then going to do is instead of paying the bank, which is going to be your principal and interest, what you're then going to do, instead of that money going to the bank, what we're going to do is we're going to pay that to you. So what we're doing is as we repay this money never leaves. We're going to continue to compound that money. But as we make that payment back, we're going to capture the other portion of the interest. Now, the insurance company does have a little bit of interest on there, but when you're dealing with one that's going to be compounding in interest while the other one's going to be simple interest, it's very, very small. So this can be used in great ways for purchasing a car or anything like that, because what ends up happening is eventually as you pay on these policies for years and years, if you use them to purchase cars, which is very common, what you're then able to do is your cash on cash return is going to be even higher. So as you make that payment back, you're going to get more in the interest on the amount in your policy. So what you're able to do is you're going to continue to capture the interest every single time until eventually it gets to the point where you're easily able to buy a car and you're almost just paying yourself for it. That's how you're going to structure that in order to be able to purchase a car. Now, one of the things, one of the warnings and kind of pitfalls that you want to avoid with this type of policy is the first thing we want to avoid is taking out the loan too early, because we want to make sure we easily have enough in there to cover that balance. Just because when we're getting that interest, we just want to make sure that there's enough in the account. And we also want to make sure that when we do take this loan, that we're not overstretching ourselves. That's the hardest part, because the last thing you want is for a policy like this to lapse. These are meant for the long term, so we want to make sure that at any point you're going to be taken care of. Now, other than that, buying a car with an Infinite Bank is a very simple concept, and what it allows you to do is just capture all the interest that you would have been paying to the bank in another way. So it's a way to recycle your money and compound your interest. I hope you enjoyed this video, and I'll talk to you guys next week.